Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenevec from Bloomberg Radio.
Well, cross it off your list, folks. We got that first inflation print of the week earlier this morning. U.S. consumer prices rose at a firm pace in the month of November, in line with expectations, solidifying expectations that, yes, indeed, the U.S. Central Bank, the Fed, should cut interest rates next week. As for the so-called core consumer price index, the core CPI, that backs out, of course, as you know, the food and energy costs. They can be volatile. Well, it increased 0.3% for a fourth straight month, Tim.
The U.S. Treasury rates dipping on the news, with more on the inflation read and the market reaction and what it all means for U.S. rates, the Fed meeting next week, and also what things might look like in 2025. With us, a Bloomberg News economics editor, Molly Smith. She's here in the Bloomberg Businessweek studio. Also, along with Bloomberg News chief correspondent for global macro markets, Liz McCormick, joining us from New Jersey. Molly, I do want to start with you. Walk us through the CPI report, because it was kind of bang on when it came to what economists and surveyed by Bloomberg would think. Also, any revisions to the prior month?
No revisions, but that's the thing, is that this was exactly in line with expectations. And if you were to just look at those numbers, though, in isolation, you think like 0.3% on the core, 4 months in a row. You take that times 12, that's 3.6% if you were to annualize that rate. That's clearly not 2% inflation. That's not consistent with that target. It's well above it. And we're thinking, why are we sitting here talking about cutting interest rates next week? But that's exactly the thing, is that the markets were really bracing for, hopefully it's not going to be worse than expected. And thank God it wasn't. So green light, Fed should cut rates next week.
So expectations, okay. So it wasn't worse than everybody thought. But as you said, we still have inflation.
We still have inflation. And interestingly, I took a look back at the estimates in the Bloomberg survey just to see, was anyone expecting 0.4? Nobody. Estimates were 0.2% and 0.3%. So if anything, maybe we would have hoped for a surprise to the downside. But again, the relief was just that it did not come in worse than expected. So I think that's just really good enough right now. Obviously, I'm sure Liz would have a lot more to say about that.
So Liz, come on in on it. You did write about the market reaction. You track it. We've also had a Treasury auction, which we'll get to in just a moment. Talk to us about market reaction. We did see some movement right after the data.
Yeah, no, I think Molly nailed a lot of it, because it is true that we, right after the data, Carol, we had 2-year yields really tumble. Now they're about flat. I'll get into, why we're oscillating around. But I think, remember the backdrop was Friday. We had that payrolls report that everyone was bracing for as well. And that came out, let's call it mixed enough, right? That people thought, because a lot of the Fed officials said, like, especially Governor Waller, I think I'll cut in December, but I got to see all the data. And he listed all the data, right, which included jobs and CPI, PPI, retail sales, a bunch of other stuff. So we thought, jobs was okay, lean into the cut a little bit. So that pricing went up for that. And then we're like, well, we have inflation next week. And like Molly said, it was just bang on. But, I'm becoming a little bit of an economist, scary maybe, but I thought so too. If you step your head back and say, wow, over 3% annualized, it's not really a good number, and the trend has not been tracking in the right direction. But I think for the bond market, they feel like, especially because let's remember, looking forward, we have so much uncertainty. We know President Trump won. We know there was a Republican sweep in Congress, but we don't really know what's going to happen. How much of the tariffs just a bargaining tool? How much will go through? Will even if they have all the same politicians on the same party, are they going to get everything through they want? So now the bond market's like, we don't know what happens next year, nor does the Fed. Powell said we're starting to try to model all the scenarios. So, but it was enough that they think the Fed wants to get one more cut in while they know what they know, right? But then you're looking to next year uncertainty, and Molly can talk to this too. There's a lot of uncertainty of kind of where the end is. What is neutral?
That's the big
where's
question.
The long run rate, right? I mean, that's I feel like I keep saying neutral the new black. Everyone keeps bringing it up. And so I think that's why the market kind of rallied. It now is stabilizing, but it was enough to say, okay, we think for sure they're going to cut in December, which is next week, right?
Why though, there seems to be this disconnect between what the data says and what traders think is going to happen, Molly, because like you said, we're not at 2%.
Yeah.
And it doesn't seem like necessarily this last mile is coming as easily as many people thought it would.
Well, I think, something I always like to think about is that markets see what they want to see. And that if we're going to price in, before the CPI data today, an 86% chance that the Fed is going to cut next week, there's not really a whole lot of room for that to not happen. Like, the numbers would have had to have been so awful,
right,
in so many levels to really, nix that possibility. The other thing, though, is that easy to look at this 1 month in isolation and think, okay, that 0.3% that we've now had for 4 months in a row, like, that clearly doesn't seem to indicate that inflation is coming down. But you look at this from a broader perspective where inflation was 2.5 years ago, and how high rates got in order to bring that down. And that rates are still very high. They haven't really come down a whole lot, right? We've only had 75 basis points of cuts so far after raising them up to 5.5%. And that was when inflation was at 9%.
Right.
Now inflation is in the 2 to 3% area. So rates do need to come down. It's just more now about the pacing and the spacing of the cuts.
I keep thinking, too, about how much of the Fed rate increases, have they worked their way completely through the economy at this point, Molly? And then, as you say, we've only had a few cuts here, and we'll see, right? All of this kind of has to work its way through.
Well, that's, I think, what, central bankers are always wondering about these, so-called long and variable lags of monetary policy. And I think there's also a lot of reason to say, though, that a lot of the disinflation we've seen, you could probably argue, has nothing to do with interest rates and just had, people just getting a little bit back to normal after the pandemic distortions.
Liz, I want to bring you back in because I did think about, we've had some auctions this week, had a 10-year, right? Just today, we had 3-year notes yesterday, nearly matching expectations. We've got a 30-year bond reopening tomorrow. But tell us about what we're seeing in terms of the auctions and what that says to us about investors willing to kind of step up to the plate here.
Yeah, I mean, today's 10-year note auction went very well. The yield at the auction came below the win issue, which is a sign of good demand. And I think, every investor I talk to, whether I want to talk to them about that or not, they bring up, well, rates at above 4%, and hey, if we went back to 4.5 on the 10-year, it's a buying opportunity because they're looking kind of longer space. Like, we do have a positive total return for the Treasury market this year. Not a lot, but a little over 2%, and they were up a little bit last year. And you figure you're getting these, coupons that are over 4%. Even if the Fed doesn't end up cutting a lot, so you don't get a lot of, capital appreciation, people feel like, hey, these levels of yields, remember for years we had such low yields, right, and we don't know. No one thinks we're going back to this uber zero rate environment, but they also don't think we're going back to, 10% yield. So if you can lock in getting these higher yields above 4%, that's why you're seeing, bouts of good demand. But there's so much uncertainty. Still, people more are leaning towards, call it the middle to the belly of the curve, 5-year notes, that kind of thing. But we did see good demand today for 10s. And then I think it's the fiscal that we really want to know what's going to happen to the long end.
Right.
When does debt issuance start to increase? Is the new Treasury Secretary, who has to be confirmed, does he accomplish some of the things he would like to do, as far as he says he wants to reduce the deficit as a share of GDP and a lot of things. So I think that's why the jury's still out.
Just quickly, Molly, 20 seconds. PPI, can this do anything, what we get tomorrow on PPI, change the Fed's thinking? Just quickly.
No, I think it's really what PPI really matters for now is like looking at PCE, just to add a few more acronyms to the list. So we get the Fed's favorite inflation gauge later this month. Depends a lot on what comes in tomorrow. So that's really more the takeaway.
Gets factored into it, correct?
Exactly. Some of those categories feed through.
All right, great stuff, guys. Both of you, thank you so much. Bloomberg News economics editor Molly Smith here in studio, and Bloomberg News chief correspondent for global macro markets, our one and only Liz McCormick out there in New Jersey. And that is today's economic data.
All right, well, we're getting some headlines here, too. Some breaking news. FBI Director Christopher Wray resigns his position, this according to Fox News. The New York Times also confirming that, saying that Christopher Wray has told employees at the Bureau today that he intends to resign before the next Trump administration begins. Remember, he was nominated by Donald Trump to be FBI director, but it also comes as the president-elect has expressed that he would like to nominate Kash Patel to serve as FBI director.
So the news out of D.C. certainly continues, and that kind of gets us to some news that did involve the FTC yesterday and a ruling. We want to get to some company news, and this is on Albertsons. Filed a lawsuit against Kroger, claiming it failed to exercise best efforts and take any and all actions, their words, needed to secure regulatory approval for the company's proposed $24.6 billion deal. Meantime, Kroger put out a statement. They refute the allegations. They say their board is evaluating next steps and looks forward to responding to claims in court. So kind of let the courtroom battle begin, or so it feels. Let's get an update on this story. We head back to Bloomberg Intelligence senior antitrust litigation analyst. Listen to her this morning, Jennifer Rhee, here in studio. You were with the gang on surveillance. Jen, we caught up with you yesterday. Late breaking headlines. I guess we kind of thought that was it.
Well, I did ask her, I said, Jen, do you think you'll be back in our studio before the end of the year? And you said, yes, I think I will. And
I want both of your crystal balls.
Not even 24 hours later, she's back.
I didn't think it would be today.
But you did indicate to us that you thought the deal was done.
Oh, yeah. And it is done. This is now not about the deal. This is about whether one or both of them breached the contract, the purchase agreement. The deal's finished. They are now in extended litigation about the merger agreement and whether or not, according to Albertsons, Kroger breached that agreement. And I think this is about the remedy that was offered to fix the problematic issues. I mean, this was a horizontal agreement between two competitors. Both Kroger and Albertsons knew it raised antitrust problems. There was no doubt about that, and that's why they offered a remedy, because you don't need to fix something if it doesn't raise an issue. The remedy wasn't good enough, and that became really apparent during the trial. It was complicated, it was piecemeal, it didn't completely resolve the concerns, and it really had an inadequate buyer. And I think the issue here is that Albertsons is probably saying, look, that was an inappropriate remedy. We weren't going to win with that remedy, and so you didn't use best efforts. That's what I'm guessing they're going to say. The complaint and all the papers are confidential and not available, so we don't know the details.
Well, that's what I wondered, if they have a legal case, because Albertsons said that Kroger willfully, breached the merger agreement by refusing to divest those assets needed for antitrust approval. Like, how do you know this world? Like, Kroger knew probably what needed to be done. I would assume it's lawyer, like, to get that deal done. How are you looking at it, as obviously more information will come out?
I think in a way it's a difficult claim. And the reason I say that is because there's a difference between the way the Federal Trade Commission might evaluate a remedy and the way a judge would evaluate the remedy. And what we have seen in the last 3 years, because the FTC has been so difficult, really, they have really not accepted anything. We've seen several cases where the parties have gone to the court with what they call a fix it first. FTC said remedy's insufficient, or DOJ has said it, and the court has said, no, it's okay, and I'm going to let the deal close. So in some respects, Kroger's using their judgment, abiding by legal advice, thinking we can go before a judge and we can convince a judge this remedy's okay, even if we couldn't convince the FTC. And, I think that it's reasonable. There's a reasonable argument that they might have had success in doing that. And so it becomes so subjective and such a difficult call.
I mean, it's a risk, right?
It's a risk.
You're kind of playing your cards and playing what you think is the right strategy.
Absolutely a risk.
Is this typically what happens after regulators scuttle a deal? Do the companies go from sort of being like, hey, we're going to be best friends forever, we're going to get married, to a very quick and acrimonious divorce?
It is not typical, but it has happened. And I go back to Anthem and Cigna. Boy, they litigated for several years in Delaware after they terminated their agreement. That was when Anthem tried to buy Cigna. They were blocked in court. Then it was blocked on appeal. And they both turned around and said the other one breached. And the crazy thing about that was that Cigna was supposed to get over $1 billion in a breakup fee. And then Anthem sued them for billions of dollars. And the Delaware court basically said, nobody gets anything. You've just spent a lot of money litigating and neither of you get anything. You both breached, but I'm not going to make either of you pay each other a fee. And, it was just such a long, extended effort with so much money spent and nothing to show for it.
Listen, when these legal cases go on, I think about it, whether it's an antitrust case, go back to Microsoft years ago, these stocks and companies kind of twist in the wind for a while. Is that part of it? I mean, Albertsons stock was up 4% today, down 1.5%. It's down about 2/3 of 1% as I look right now. But I mean, is this Albertson not loving that its stock has been kind of kicked around during this process? Like, is there a financial element of like, this has not been great for me? And I wonder, is Albertsons damaged goods now?
Well, that's exactly it. That's what a breakup fee in a purchase agreement is meant to take care of. Because in that interim period, that long investigation and litigation, there is no doubt the stock of the seller is hurting. It goes up and going down, but the seller also the business struggles, right? Because they can't enter supply agreements. They lose employees. They think they're going to get bought and they're going to lose their job. So why not take something else that comes along before they're fired, or laid off? And that is why they're supposed to get a breakup fee. And I think in this situation, Alberts may feel that they've been pretty significantly damaged. This has been a long road for a deal. They don't usually last this long. And they are supposed to get $600 million in breakup fee, but maybe they feel they really need more to be made whole.
Why not try again in the next administration? Truly, I mean,
is it really over?
Andrew Ferguson
Yes.
would serve as the agency's chair.
That's right.
If all goes according to plan. We just learned that late yesterday.
We did.
Would this work under a different chair?
I don't think it would. So let me say this about the next administration. I think there's a lot of exuberance on Wall Street about deals. And I do think more deals are going to get closed, absolutely. But at the end of the day, big problematic deals, especially between horizontal competitors, are still going to go get challenged by an FTC, even if it's run by Andrew Ferguson. And I think this is an example of one that probably would have been challenged under Republicans, too.
Are you sure you're not going to come back later this week?
You might.
We will stand by. Always standing by for you. Jen, thank you so much. Jen Rhee, Bloomberg Intelligence Senior Antitrust Litigation Analyst.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So let's get to what's become an annual list featured by our Bloomberg Businessweek team. And on that, just one little note, if you never want to miss a Bloomberg Businessweek story, you can do so by becoming a subscriber, unlocking all of the deep reporting, the analysis from reporters around the globe, including unlimited access to Businessweek. So for more, head to Bloomberg.com/subscribe now. And so now let's get to that annual Bloomberg Businessweek feature, which you can read on the Bloomberg and at Bloomberg.com/Businessweek. It is about the 50 companies to watch in 2025. And the list, Tim and I know this list well. We've done it. We look forward to it. It's compiled by our Bloomberg Intelligence team. And a lot of factors go into it.
Oh, yeah, they do. A lot of factors and a lot of people, too. With more, we head to London and to Bloomberg Intelligence Senior European Strategist Tim Craighead. Tim, we love going through this list every year and remind everybody just how it's put together and the catalyst here. It's not a list for, to tell investors okay, these are the companies that you should be investing in for these reasons. It's sort of a more holistic approach. Talk us through the approach here.
Yeah, absolutely. And thanks for having me on. So the 50 companies to watch are based largely off of a group of companies that we have as focus ideas. And our focus ideas are where our analysts around the globe on a bottom-up basis, sector by sector, are looking for fundamental situations where they have a really strong view, a high conviction view that they think is out of consensus, that's differentiated from what the market is thinking. And we zero in on 50 out of that broader list that have specific catalysts in 2025, in this case, that we think will bring the market around to our point of view. And, it's pretty balanced across sectors. About half are U.S. or Americas oriented. The other 50% are sort of equally split between Europe and Asia. About 20% are negative, about 80% are positive. So there's a good balance around. And, there's lots of different drivers, as you rightfully said up front, that are behind the list, company by company and sort of theme by theme.
And there are some buckets, Tim, that they fall into, whether it's cyclical recovery, AI related, which tends to hit a lot of companies nowadays. But give us a little bit of context on that.
Yeah, it's an interesting thing, because if I actually juxtapose this year versus last, AI was a big deal a year ago, but it was a lot of the big AI companies, the software companies, the LLM guys and whatnot. This year, it's more geared towards the semiconductors and enabling technologies behind it. We can get into some of those. China was a big deal last year, but it was all negative about the property crisis. This year, the list has changed complexion from a China perspective, and it's more positive oriented about a cyclical recovery because of the stimulus that's coming through. And you can also look at other topics such as a broader base cyclical recovery in Europe or the US because of lower interest rates. Mm-hmm. There's a lot of innovation and new product stories in there as well, and some other factors.
All right, we want to get into some of the names. I know it's alphabetical, but we got to get into, first of all, Broadcom. It's something that we are following in a big way. It's in the news today. Apple developing a server chip designed especially for AI, working with Broadcom on the chip's networking technology.
It's up 6.3% right now.
It's one of my top gainers today. Why are you guys highlighting it?
Yeah, well, Broadcom is interesting because you think of this as a semiconductor company, but it's much more than a semiconductor company because it's gotten into infrastructure software, and it's one of the few companies that combines semiconductors and software. And importantly, it's part of the AI theme because a lot of what it's doing feeds into the whole AI story, whether it's with Google or Meta or what have you. So, it's a pretty intriguing story. And, the software business came from, their acquisition of VMware a couple of years ago. Okay.
I want to go to Tesla, another company that's in the news today. Shares jumping to a record.
Nice job with the list, guys, by the way.
$1 billion rally in 6 weeks. Yeah, pretty amazing how you can see the future out there at Bloomberg Intelligence. Why is Tesla on the list this year?
So Tesla is there, and I'm going to bring in one other company at the same time. Okay. This falls into that category of new products, innovation, and whatnot. Obviously, Tesla is all about electric vehicles, but importantly, as we look into next year, there's new vehicles that are coming through, an important refresh of their core cars, and we think that that's an opportunity for a lift. Similarly, Porsche. We all like Porsches. I think we all like Porsches. I'd like to like a Porsche. They've got.
You're speaking.
Well, I got to tell you, you can like it. It's just right about ownership, right?
Yeah. Well, it's funny because back in the day, these were relatively affordable. The way that Porsche has driven its business, pun intended, is to go higher and higher end to where the average selling price of their cars are quite significant, and essentially what they're trying to do is attain a Ferrari-like profit margin, and they've got a number of products, whether it's hybrid related or other, that should help propel the company along and its profits and its margins along. Interestingly, and it flies a little bit in the face of Tesla. Clearly, that's pure battery electric vehicle. There has certainly been a pause in the U.S. and in Europe about that whole sort of transition to electric vehicles, and Porsche's core combustion engine business is doing better than what a lot of people thought it was going to do, and frankly, they make more money in the old stuff.
Oops, a little bit of a freeze there. We're going to try and reconnect with Tim Craighead of our Bloomberg Intelligence team because we want to keep talking through some of these names. He was just talking about Porsche, and so really highlighting them in a positive way, their ability to raise prices. We've talked about high-end in many ways doing okay in this economy, but it's not true across the board.
Hey, let's get right back to Tim Craighead out there in London. Looks like we've shored up that connection a little bit. Tim, I want to stick with the transportation theme here and talk Airbus because a lot has happened with this duopoly over the last year, including at the beginning of this year, that a door panel blowing out on that 737 MAX, that Alaska Airlines jet. And that sort of sent Boeing into its most recent struggles, and new executive there and the like. Why Airbus on the list?
Yeah, so there's a couple of elements that play in. Part of it is just pure cyclical recovery. There is continued recovery in air traffic. There's continued recovery and order flow for airlines. And at the same time, there's been a real constraint on supply, on the supply channel going into the airline or airframe business. We think both of these elements are in play for 2025, and to the degree that Airbus, we think, continues to gain relative market share versus Boeing, there's a host of factors that play into a pretty positive view here.
All right, I like planes too, but I also like makeup. I'm just going to put it out there.
I thought you were going to say trains.
That would have been.
There is a train company on the list.
Darn you.
A railroad on the list.
All
just
right.
a deep tease.
All right. We're going to get back to that in a moment.
Okay.
Estee Lauder, I want to bring that one. It's been under pressure. It's a well-known company, iconic company in the cosmetic business. If you go back to Estee Lauder, who created it, it has gone through some changes. It's down, I think, more than 40% this year, but it's been on quite a rally since kind of mid-November, up about 30%. You guys highlighted it. Are you expecting some kind of not liquidation, but some kind of, I don't know, event that maybe changes the fortunes going forward?
Yeah, well, so Estee Lauder is an interesting one because you have to love the brands that make up Estee Lauder. Whether it's Estee Lauder itself or MAC or Clinique, what have you. But it really does seem like they've lost a bit of an edge in some of their brands. They're also particularly skewed towards airport travel-related retail, which continues to be under pressure, notwithstanding air travel coming back. Spending on duty-free has continued to remain a pressure point. We think Estee Lauder continues to have some potential for disappointment in the first half of the year before maybe things then come around. They've announced a big restructuring that will happen. We think actually that restructuring charge that they'll take could actually be even more with a new CEO who's come in place. So stay tuned. By the end of next year, there could be an interesting recovery, but it's a rough road in between now and then.
All right, I'm getting back to transit and logistics.
I was going to say planes, makeup, and trains.
Yeah, planes, makeup, and trains. Doesn't have the same ring to it as the John Candy film. Norfolk Southern. What's going on with Norfolk Southern?
So it's an interesting story. I have a long-standing association with Norfolk Southern, previously Norfolk and Western. My dad worked there for over 40 years, God rest his soul. And they've had issues over the last couple of years, unlike Union Pacific, which actually was on our list last year, that had really gotten moving with precision rail, to be very precise in the logistics, and it's really good for customers and it's great for their margins and efficiency. Norfolk Southern had been lagging. They have a new CEO who's in. They're bringing management in who's much more geared towards this precision transportation. We think this is a recovery story in 2025, somewhat akin to what we had seen at UNP last year.
Really quickly, 20 seconds. You said 20% negative, 80% positive stories. Is it always that mix, or does it tell you anything about kind of sentiment or what's going on in the markets? And you just got to be really quickly if you could.
No, we try to have a balance of the standard view is looking at glass half full, but we try to keep an eye out towards where do we see expectations that have run too far, too fast. And, our ideas range from a couple of banks to some consumer product companies to some tech companies. Yes. It's
a great list. Palantir's also on it, Okta, Tapestry. Check it out, everybody. Tim Craighead, thank you so much. Senior European Strategist, Director of Research Content at Bloomberg Intelligence.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, everybody, we're going to cut to the chase. AI, it is everywhere, seems to be in every conversation that we have. And just one story on our radar on this Wednesday, OpenAI's Chief Financial Officer, Sarah Friar, saying it's reasonable to eventually charge business users thousands of dollars a month for its artificial intelligence software to better reflect the value that the technology provides to companies.
I will say the best recipe for grilled chicken I've ever gotten has been from OpenAI. So
you're ready
ChatGPT.
to pony up and pay?
No,
that's
the free version. That's the free version.
All right, let's get some thoughts on Yes AI and tech trends for 2025. With us is Mike Bechtel. He's Chief Futurist at Deloitte right here in studio. Happy almost New Year. How are you?
Happy New Year to you. I'm great, and thanks for having me.
Thank you. You guys, 16 years in running, your annual tech trends report. First of all, step back. We always care about what goes into when somebody does a survey, somebody does a report. How do you determine and identify the trends?
Well, Carol, it's interesting. I like to tell my clients futurists are closeted historians. And a big part of making heads or tails out of what's coming is by looking at what's been. And so in our 16 years of tech trends, we've learned that there tends to be about 6 areas that have really buttered enterprise bread. And by that, I mean, made or save money.
Yeah.
The way we interact with machines, the way we extract insights, the way we power the math behind it, those 3 buckets have always mattered. It might have been older tech. Today, it happens to be things like AI and augmented virtual reality. But the point is that the categories tend to stay the same.
Okay.
Then there's a whole bunch, 3 precisely, categories that kind of require us to take a breath and make sure we don't mess up today and pursue it tomorrow. Cybersecurity always matters. Modernizing old rusty core systems always matters. And then there's the people finance side. So those are really the big 6, and there's always something new each year.
All right, Carol knows I'm going to go here because I just returned from San Francisco and riding in my first Waymo.
Okay.
Just when is this going to happen and we're all going to be in cars without steering wheels? I have no interest in ever driving again, I'll be honest.
Well, we're futurists ever, resistant to giving you hard timelines on that. But I'll tell you what, Tim.
Because this seems to fall into the core modernization bucket of your analysis.
Well, what's interesting is for this year, it falls into the compute side. Namely, for 12, 15 years, right? Mark Andreessen Horowitz, he famously said, software is eating the world. Everything's all about software and bits. And I used to be a VC. We wouldn't look at something unless it was software as a service. Let me tell you, this year in our Deloitte tech trends, we're really starting to see that physical hardware suddenly matters again. It's gone from commodity you don't think about to, oh my goodness, it matters. And part of that, Tim, is robotics, physical robotics. 85% of the world's economy is about physical stuff, moving products. So much of the AI revolution is about bits and pixels. And so things like, but not limited to Waymo, they're going to be coming in hot because people are starting to see, whoa, we've neglected the physical lived space for a good 10, 12 years. So I think it's coming. It's coming this decade.
Or do you feel like, are you ready?
I was ready years ago.
Giddy up, right?
I mean, nothing motivates you to want a future like this than having kids and not wanting them to get behind the wheel ever.
I hear you. You want it safe.
Briefly, I would tell you, one of the other things we found in our Deloitte Tech Trends research is that, last year, the conversation was, like robots coming for jobs and, AI replacing people.
Bring it on.
Well, let me tell you though, Tim, it's more nuanced. I think it's more optimistic than that. What we're seeing this year is it's AI automating muck to free folks on higher order magic.
About, yeah.
So that's what you're saying. It's like if
one.
I can do less of the annoying stuff, I'll have more bandwidth to do the interesting stuff. And that's what our clients are showing us.
I am curious, and forgive me, I was actually trying to go back to your report that was maybe indicating what was going to go on in 2023, but how much of AI did you feel like you guys got right? How much were you surprised by? Because the impact it has had certainly on our conversations and the investment world has been pretty powerful.
Yeah, Carol, I think the part we got right was that AI isn't new. There's an old computer scientist. He had this great quote. He said, AI is whatever the heck computers can't do yet. And I love that definition. It works 10 years ago. It'll work 10 years from now. But I think 2 years ago in our report, we saw AI as one of, say, 6 movements that are really going to move the market and affect our clients. I don't think we were prepared for the fact that it would become sort of the foundation for everything. Yeah. And so, we had trends about cybersecurity. Well, AI's in there. We had trends about, as we said, physical robotics, about HR and human staff augmentation. AI's in there and there. And so I think the part we might have gotten wrong was not recognizing how foundational it'll be. It's electricity. It's the World Wide Web. It'll be baked into everything.
Are you scared?
No,
I'm not.
No, I'm not. I actually think technology can be a really good thing. I just, I'm hoping the regulatory environment kind of keeps up with it. Yeah.
And yes, $1 trillion question.
20 seconds. Is there something non-AI that you think keep this on your radar?
Yes. I think the big thing we've uncovered this year that's off the AI path is quantum cryptography and cybersecurity. Here's the punchline, and here's the term, the headline, Y2Q. Remember Y2K back in the day?
Yeah. I had a walkie-talkie on New Year's Eve, ready to talk with my team in case everything went offline. Seriously, here at Bloomberg.
The bummer with Y2Q is we don't know precisely when it comes, but our clients need to be ready for it.
Y2Q. Are you ready for that?
Who knows?
Mike Bechtel, thank you so much, over at Deloitte, Chief Futurist.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get a little bit into healthcare, which is obviously something that has been top of mind for a lot of people given the events over the last week. And great to have back with us with someone who has really a great vantage point when it comes to what's going on in healthcare, and specifically the nursing community, which is such a big part of it, certainly a support network within the healthcare community. Back with us is Dr. Iman Abuzeid. She's co-founder and CEO of the nursing talent platform Incredible Health, and they essentially connect nurses and hospitals. Dr. Abuzeid joining us once again from Austin, Texas. Great to have you back with us. How are you?
Doing well. Thank you so much for having me again.
Well, it's great to be talking with you. There is a lot that we want to get to, but top of mind is something in our planning call and thinking about our conversation with you today that we wanted to ask you about, and that is something that, because you are so locked into the healthcare world, and that is the fatal shooting of the United Health executive, a tragedy, no doubt about that. But something that has also captivated millions of Americans and set off a pretty fiery online debate about health insurance. What do you hear since that incident on your platform among the nursing community? What are you seeing about the thoughts about the healthcare system, what works, but also maybe some of the injustices within the system? Is our healthcare system broken in some way?
Yeah, so when in speaking with healthcare workers, whether it's nurses or physicians, there is quite a lot of frustration with the healthcare insurance industry, particularly when it comes to denials and claims that aren't accepted for patients. So, I mean, some of the debate that this incident has highlighted is certainly being intensely debated by healthcare workers as well.
And I do wonder where they hope it goes from this point. Again, a tragedy. And no one wants to see what happened earlier this week happen again. But having said that, the healthcare system, I feel like I've been talking about it for years, for decades, and the problems that are there. Many thought Obamacare was a step forward, but even some say there needs to be some work there. So what is it that you and maybe those on your platform and others within the healthcare industry, what are you hearing about they hope is maybe the narrative or conversation that happens next?
Right. Ultimately, what we want to make sure is that Americans and patients, right, get the care they need. And so anything that could be blocking that, they want to remove any blockers to access to care. And so the insurance company is a very important part of that. And some of these challenges need to be addressed. We do work with health systems, specific ones that have struggled in their negotiations with United Healthcare and others. And we even work with health systems that had to drop United Healthcare as a payer. So certainly this is intensely debated, and the debate is mostly around, hey, what do we need to do to ensure we can deliver care to Americans?
One thing that's been particularly shocking to me to learn over the last week is the way that doctors have struggled and fought with insurance companies over denials for prescriptions that they write to patients for anti-nausea medication in the wake of chemotherapy, or procedures that they see as essential that insurance companies don't provide, for transportation for babies who are just born who need special services, but that transportation does not get approved for days and days. Why does this happen in this country?
Right. I mean, look, the frustration level around this topic is high among healthcare professionals. And we've talked before about the burnout challenges among healthcare professionals. And, you know, this kind of administrative load that they have to take on just to get what are considered relatively straightforward claims approved is challenging. And it does pile on to the burnout challenge we already have with our healthcare workforce.
One thing you're trying to do to alleviate that burnout challenge is to use technology, especially AI, to help these nurses, help those on the platform of Incredible Health, do their job more efficiently. What are you doing with this AI-powered marketplace to help alleviate the shortage of nurses here?
Yeah, so our vision and mission is to help healthcare professionals live better lives and help them find and do their best work. And so, yeah, our two-sided marketplace is enabled with software and with AI. And we have many features that drive the success here. Ultimately, what we're trying to do is expand the number of opportunities for nurses, and then also ensure that the health systems that we work with are able to hire the talent they need. We now work with over 1 million US nurses are on the platform using Incredible Health to manage their careers, and over 1,500 hospitals use the platform as well. We were one of the first platforms to add AI to our platform. For example, we have a resume wizard feature that ensures that nurses can generate a resume from the Incredible Health mobile app, which is completely free, and can create a high quality resume to make sure that they're not left out of the job search experience.
All right, Dr. Iman Abuzeid, we're going to have to leave it there. Co-founder and CEO of the nursing talent platform Incredible Health. Always great to have you on the program, joining us from Austin, Texas this afternoon.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. 19 minutes to go. And man, we've got a strong rally, especially among those big tech cap names. I love it because I just keep thinking about every year we go through, stop putting money there, stop putting money there. The valuations are crazy. And then you just see investors buy in.
Yeah, we'll see what 2025 looks like.
Yes.
We got back with us, Sevasti Balafas, CEO over at GoalVest Advisory. GoalVest Advisory has about $600 million in assets under management. Sevasti joins us here in the Bloomberg Interactive Brokers studio. You have some really interesting tech investments on the private side. Yes. I want to talk about those in a minute, but sure. I want you to weigh in on what's happening in public markets when it comes to tech, because as Carol mentioned, we're seeing quite the rally today.
It's nuts.
Some of the indexes at records as a result of the way tech is climbing today. Things are getting expensive, or is this okay?
Things are getting expensive. It's true. We do think about that, but I think there's more room to run. It's exciting. I mean, next year, we are expecting 30% growth in earnings from these tech companies. So yes, it's expensive, but at the same time, earnings are backing it up. But at the same time, given where we are with the economy as well, interest rates are coming down in a good place, though, labor market in a good place. But so things look good right now. That can quickly change. So when things are expensive, we do need to consider what else are we going to be buying into? Should we be trimming? Should we be not necessarily selling from tech? Again, high expected earnings next year, but selling or trimming and rebalancing for sure.
Sevasti, does it matter what the Fed does next week and into 2025? Because there's that thinking of, we talked earlier about the CPI print, and if you carry out what we've seen over the last 12 months, I think it was, or 10 months in terms of inflation, we're well above that 2% target.
Yes.
So why do we need a rate cut
yes.
if inflation is still trending well above 2%? And the economy seems to be doing well. So tell me how you're thinking about that.
Great question. And interest rates absolutely matter. I do think the Fed will cut, because it's not only interest rates, but interest rate expectations. The Fed is expecting this cut to happen. Inflation.
But that's not their mandate. It's inflation and employment.
And labor, exactly, and employment. But they've communicated pretty well, I think, in terms of the December cut that we will expect to see. Labor, look.
Do you think they need to cut? Do you think it makes sense?
I do. I think we need to get to a lower terminal rate. I think we need to go down that path. Interest rates were essentially zero before they started raising rates in 2022. They've started to normalize rates. So I do think at this point, because of the communication that they've given the market and in terms of market expectation, yes, I do think they need to cut in December, given that unemployment overall, it's a mosaic of numbers that we need to look at to conclude on unemployment, but we're just one print away from starting to talk about maybe unemployment not looking so great. So companies aren't necessarily laying off, but not necessarily hiring a lot either. That could change very quickly.
The challenge, though, is inflation hasn't come down to that 2%. So even if we do see the employment, if we see the job market softening a little bit, what if we don't see inflation hit that 2% goal?
I don't know that we will. It's a different environment, and also the 2% number, that headline number, there are certain underlying elements that aren't necessarily reflected. So I don't know that. So the Fed has talked about they are more lenient. It was that 2% threshold that they had for a while, but they're willing to see it come down towards the 2% number. They're not as strict with the mandate on the 2% number.
All right, so let's talk investments. You've been super psyched about talking kind of about where you.
Have you ever had Olipop?
No, but I know of it.
Okay, it's like the quote unquote healthy soda. I don't know.
It was all
So I'm
over.
told.
Was it the Super Bowl? Was it the Super Bowl where we saw ads or
It was
somewhere?
all over my fridge over the summer.
It's all over Whole Foods.
Oh yeah. So that was one of your investments.
Yes.
Other investments, Anduril. Really hot defense company based out there in LA. Palmer Luckey of Oculus fame started that company. These are previous investments in other funds. You've recently launched the Venture Growth Fund.
Yes.
What that does is it gives accredited investors through RIAs access to venture deals. What's the thinking behind this?
So part of it is going to the beginning part of the conversation where we're seeing public tech, still love it, but also very expensive, or public markets expensive. I think it's a good time to recalibrate portfolios. Growth has outperformed value. Large cap has outperformed small cap. This has been happening for a while. Stocks have outperformed bonds. This has been happening for the last couple of years and decade, actually, if you talk about growth in large cap, et cetera. So it's time to look at where else can we diversify. Private markets is one of those areas that we can look at. Back in 2020, when rates were very low and we saw these high valuations in the private markets, we saw that come down in 2022. Private markets were at all-time lows. Public markets have since gone up. Now, I do expect, and I do think we're going to see a reversal of that. So we had launched Fund 1, and we made some of those investments in Olipop CoreWeave, which I'm excited about.
Yeah.
Could be one of the first IPOs we see next year. So we had made those investments. Now it's about Fund 2. We're continuing with the private market. So for clients looking to rebalance but still want that growth potential, private markets, I think, is a great way to go.
So private markets, so you're not necessarily speaking about private equity or private credit. You're actually early venture, like in companies that have not yet gone public.
Not yet gone public. For us, it's not early venture. It's the later stage growth companies that we're looking at. But when we start thinking of AI, for example, all the money that has been spent in AI and investments in AI, we had AI infrastructure investments. What's round 2 of that, or what's the next stage of that? How is AI? What are the applications of AI? So you may have heard of companies like Harvey, for example, that they're a co-pilot for lawyers, or Magic, co-pilot for coding teams. So AI in use in a way that will actually have continued productivity gains. I think that's what we're excited about.
I feel like, is that what Anurag was talking? He was talking about software, right? In terms of AI.
Same
so
thing.
It's like platforms, right?
Yeah, the idea of like incorporating these, not necessarily chatbots, but AI assistants, and Salesforce is betting big on that too. Insomnia cookies.
Yes.
Have you had an insomnia cookie?
I have not had it.
Pretty good. Open late, order them.
Do you do this? Have you done this?
Yeah.
Totally.
Yeah.
Okay.
Who doesn't love cookies in the middle of the night?
Within 30 minutes, warm, baked to your door.
Elizabeth, our YouTube producer, saying that she had so much insomnia in college, the delivery guy knew her. So that's a good sign. That's one of your investments too. But
Yes,
it's like Krispy Kreme had some, JB Holdings had some. What happened there? Like, what's the status of that investment?
Yeah, so they're growing great. I mean, they're expanding. We know them in New York City. They're less well known across the U.S., but they're expanding. So we're really excited about them. But that's another example of a CPG company, a consumer goods company, similar to Olipop that we like. So for round 2, Fund 2, we're looking at additional consumer names. But again, as I mentioned, the AI application, that's a big part of it.
Now I just want a cookie.
Okay, so from drones at Anduril to cookies at Insomnia Cookies, the investments sort of run the gamut.
Can I get a drone to bring me a cookie right now?
Those are not the type of drone. You don't want these drones near you at Anduril.
Yeah,
these are not the friendly drones. Let's just say that.
Sevasti, thank you so much. Really appreciate it. Happy holidays. Great to have you back in studio. She is CEO of GoalVest Advisory. You are listening and watching Bloomberg Businessweek.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.